Usually when you look at a mega cap tech stock, you kind of expect a certain degree of structural stability.
Right, yeah.
Like, we tend to view these half-trillion-dollar companies as aircraft carriers. They maneuver slowly, their charts map out these predictable, gentle slopes, and they just sort of steadily compound capital.
Exactly. They're supposed to be safe.
But looking at Oracle Corporation's April 2026 snapshot, I mean, you are not looking at an aircraft carrier. You are looking at a high-speed derailment that is somehow trying to rebuild its own tracks while still in midair.
That is a great way to put it. It's wild.
So the high-stakes question we're putting in front of you today for this deep dive is this. Is Oracle a massive, fundamentally undervalued opportunity just waiting to explode? Or is this entire recovery a really dangerous falling trend that's flashing massive sell signals?
Right, the ultimate value trap or the ultimate buy.
Exactly. We're going to cut through the noise, look at the actual data, and really debate the reality of Oracle's crazy, volatile recovery. But before we jump into the numbers, just a quick reminder to please like the video, subscribe to our YouTube channel, and it is compulsory, yes, compulsory to leave your feedback in the comments. We want to know what you think.
Yeah, let us know. And just to set the ground rules here, we are just having a natural human debate about the data today. None of this is financial advice. We're just two people looking at the numbers.
Right, absolutely. So let's set the stage. We are framing Oracle's current situation as this high volatility recovery. They are trying to pivot into what we're calling an AI utility model.
Yeah, it's the single most polarizing debate in the institutional space right now, frankly. I mean, we are watching a legacy software titan attempting this incredibly violent metamorphosis into a physical infrastructure company.
Metamorphosis is a good word for it.
Right. And the underlying data, it isn't just mixed. It is violently fracturing in two completely different directions, depending entirely on your time horizon.
Okay, so let's parse that fracture. And I think we have to start with the sheer aggression of the recent price action. Let's look at the data from our April 21st, 2026 snapshot.
Let's do it.
The stock is sitting at $181.17, up over 2% for the day. But the wider context of how it got there is honestly staggering.
Yeah.
We have a 52-week high of $345.72.
Yeah.
And a low of $130.99.
Bloodbath.
It is. I mean, okay, let's unpack this. It took a terrifying dive from 345 down to 130. And recently, it's rallied 14.1% in just the last 7 days and 21% over the past month.
It's a massive bounce.
But to me, it looks like a bungee jumper.
Yeah.
The cord is snapping back up. But is the cord actually secure, or is this just a dead cat bounce? Who is actually stepping in to buy at these levels?
Well, what's fascinating here is the institutional order flow.
Yeah.
When you see a macro drawdown of that magnitude, I mean, dropping from 345 to 130, the first place you look for conviction is who is doing the buying.
Right. Follow the smart money.
Exactly. And the dark pool prints are super illuminating here. We are seeing heavy accumulation off exchange. And if you look at the options market, there are highly aggressive call option sweeps right near that 181 strike level.
Oh, wow. Really?
Yeah. It shows high conviction buying from really big players. They aren't just cautiously dipping their toes in, they are aggressively positioning for immediate upside. But, there's a weird wrinkle here, too.
Oh, the mini tender thing.
Yeah. We have to warn you about this unsolicited TRC Capital mini tender offer.
Right. I saw that in the notes. Explain that because it looked super shady to me.
It is shady. So TRC Capital put out an offer to buy shares directly from retail stockholders at $140.50.
Wait, $140? But the stock is trading at $181. Why would anyone do that?
Because it's a low ball trap. They're trying to exploit the psychology of retail investors who are just exhausted. If you watched your portfolio bleed out from 345 down to 130, you might get this official-looking document offering you 140, and out of pure panic or fatigue, you just hit accept without checking the current market price.
That is wild. And because it's a mini tender, like under 5% of shares, it bypasses a lot of SEC disclosures, right?
Exactly. It's totally unsolicited. So if you are a retail trader holding Oracle, you really need to ignore that trap. But from an analytical standpoint, it proves that distressed asset buyers see the 130 to 140 range as an absolute floor. They think it's mispriced down there.
Okay, so big players are buying the dip. But to figure out if Oracle is a true bargain or just a massive value trap, we have to, open the books, look under the hood.
We have to look at the financials.
Right. Why did the stock crash in the first place, and why is it rebounding? So walking through the fiscal 2025 and 2026 financials, the revenue numbers look incredible on the surface.
Yeah, top line looks great.
Annual revenue was super strong at $57.40 billion.
Hmm.
And if you isolate just the February 2026 quarter, they saw a 22% year-over-year jump to $17.19 billion. Net income is healthy too, sitting at $12.44 billion annually.
Sounds perfect, right?
Right. But then you look one line down, the February quarter free cash flow was negative $11.48 billion.
Yeah. Negative 11.5 billion in a single quarter.
Wait a second, let's just pause on that. They pulled in over $17 billion in top-line revenue in 3 months, but their cash flow is negative $11.5 billion. It's like a restaurant that is packed every single night. There's a line out the door, but they're going broke because they keep tearing down the kitchen every weekend to buy bigger ovens. How is this sustainable? Add to that, total debt is sitting at $134.6 billion.
Yeah, that debt to equity ratio is up at 4.83. It's massive leverage.
Almost 5 to 1. So how do they survive this?
Well, this connects to the bigger picture. This is the reality of becoming an AI utility. The market historically values Oracle as a software company, right? High margins, low capital expenditure. But that negative cash flow is driven by a $50 billion CapEx spending mandate.
$50 billion with a B.
With the B.
Right.
To build physical AI infrastructure. We're talking about a single $14 billion facility in Michigan. They are buying land, building massive data centers, securing power grids. They are fundamentally changing what their company does.
But still, that $134 billion in debt, that's a ticking clock.
It is a risk. But you have to look at the balance sheet reality. Against that debt, they have $168.36 billion in total assets. So they aren't insolvent. The danger is interest costs. What happens if interest rates stay high or climb?
Right, because you have to service that debt. You don't get to tell the bank, oh, sorry, our server delivery is delayed, so we're skipping our loan payment this month.
Exactly. And that fear is why the stock crashed in the first place. The market looked at all that debt, looked at the CapEx, and got terrified.
Which brings us nicely to the actual battlefield where all this fear and greed is playing out. The technical charts.
Oh, the charts are a mess.
It's a massive tug-of-war. The technicals show a really stark conflict between short-term optimism and long-term doubt. Let's break it down. Short-term indicators are super bullish right now.
Yeah, short-term is looking great.
Because of the prices at 181, it is comfortably above the 20-day and 50-day simple moving averages, which sit around 152.39. So those are flashing solid buy signals. And the MACD is positive at 4.27.
Real momentum. And the RSI is hovering between 60.78 and 67.32. So it's neutral to slightly overbought, but not exhausted yet.
Right, but then you zoom out. The long-term 200-day simple moving average is sitting at 215.11. And because the price is stuck way below that, the 200-day is flashing a glaring sell signal.
Yeah, it's a huge overhead cloud.
So we have strong short-term momentum, but we are technically stuck in a medium-term falling trend channel. This brings up my main concern for everyday traders. If the stock hits immediate resistance at 185.67 or major resistance up at 215.40 and gets rejected, isn't this exactly where everyday retail traders get caught holding the bag?
Yes, 100% yes. That is the definition of a retail trap.
Lure them in with the green arrows.
Exactly. Retail traders see a 21% monthly surge. They see all this short-term momentum and they jump in. But they don't realize the stock is technically still in a macro bearish posture. The 200-day moving average is acting like a ceiling.
So if it hits that ceiling and fails?
If it fails to break through, say, 190, it could trigger heavy, heavy selling pressure. The algorithms will just start dumping.
And where's the floor if that happens?
Well, key support is at 176.34 right now. If it breaks below that, it could easily tumble all the way back toward its major structural floor, down at 136.48.
Wow. So you're risking a drop back to the 130s just to chase a bounce to 200.
Yep. It's incredibly high risk.
Which perfectly mirrors the fierce debate among Wall Street analysts right now. Is this stock fundamentally undervalued, or is the whole thing just a mirage?
It's the bull versus bear debate of the year.
Let's look at the consensus. Officially, the street calls it a moderate strong buy. Out of the analysts covering it, we've got 34 buys, 26 holds, and surprisingly, only one sell.
Just one. Yeah.
And the average price target is $243.87. That's roughly a 34.6% upside from where we are now. There's even a high target out there calling for $400.
Which is incredibly optimistic.
Right. Let's outline the bear case first, because to me, it seems so obvious. You've got massive leverage, like we talked about. You've got negative free cash flow. There's the risk of serious delays in deploying these AI data centers. And We haven't even mentioned the human costs yet. They just recently announced layoffs of 30,000 staff.
Right. 30,000 people.
You don't cut 30,000 jobs if everything is running perfectly.
Yeah.
That looks like panic to me. So that's the bear case. But then, on the flip side, the bull case is anchored by this unbelievable $553 billion backlog.
Over $500 billion in contracted future revenue. It's insane.
Yeah. Plus, their Oracle Cloud Infrastructure segment, OCI, just posted 84% growth. And they've inked these massive multi-cloud partnerships with AWS and Google.
Which is huge. Nobody thought AWS would partner with them like that.
Right. Forcing your competitors to use your database architecture is a huge flex. And management was so confident, they raised their FY 2027 revenue guidance to $90 billion.
So there's your bull case.
But here's where it gets really interesting, to me at least. The valuation. The PE ratio is currently sitting up at 31.18. For Oracle, historically, that is incredibly high. Are these analysts just completely mesmerized by that shiny $553 billion backlog and just totally ignoring the 30,000 people who lost their jobs and the mountain of debt?
Well, this raises an important question, right? The core debate between the bulls and the bears really just comes down to one thing: timeline.
Timeline. How so?
If you look at it long term, that $553 billion backlog proves there is immense future demand for what they are building. The multi-cloud partnerships prove their tech is sticky. So long term, a 31 PE might actually be undervalued if they hit that 90 billion revenue target.
Assuming they actually build the data centers to fulfill the backlog.
Exactly. And that's the short-term view. Short term, this looks like a terrifying value trap. The execution risks are astronomical. They have high interest rates on $134 billion in debt. What if the Michigan facility is delayed by 2 years because of supply chain issues?
Right. The debt payments don't pause.
The debt payments don't pause, but the cash to pay them isn't coming in yet. That's why the bears are screaming that this is a trap.
So to summarize this whole deep dive for you, the listener, if you're looking at the short-term outlook, it really hinges on whether the stock can hold that $175 support line and push through resistance toward 200. It's a technical battleground right now.
Oh, totally.
But if you're looking long-term, the outlook depends entirely on whether Oracle can execute. Can they scale their physical AI infrastructure fast enough to convert that $553 billion backlog into actual spendable cash before the interest on their debt becomes totally unmanageable?
That's the billion-dollar question. And, whether you are actively trading this name or you're just watching the tech sector from the sidelines, you have to realize that Oracle is the ultimate test case for this whole AI utility business model.
Yeah, they're the canary in the coal mine.
They really are. They are proving that in this current AI arms race, making money in the future requires burning truly unprecedented amounts of cash in the present. You have to spend $50 billion to make $90 billion.
Which leaves us with a pretty intense thought to end on. If tech giants like Oracle have to become heavily leveraged utilities, literally taking on hundreds of billions in debt just to build the grid and compete in the AI space, what happens if the AI demand cycle slows down even a little bit?
Oh, man.
Right? What if the demand plateaus? Does the whole infrastructure grid short circuit? We are talking about a systemic financial risk if these data centers sit half empty. It's something to seriously think about before jumping into this volatility.
Absolutely.
Think about that as you navigate the markets this week. Thank you for joining us for this deep dive, and we'll see you next time.